from project development. I myself work for a company called Trove Research. We focus specifically on analyzing the dynamics of the voluntary carbon market, and I'll be moderating the panel today. So by way of introduction, really just framing the situation here, I've got a slide up, thinking about the challenge that we face and the possibility for leveraging private finance to move us towards a low carbon economy. A quote here from the United Nations: a global transformation to a low emissions economy is expected to require investment of at least $4 to $6 trillion per year. And what avenues can we take to bring private finance to address this challenge and to meet that gap between the investment required and currently the amount of financing going into this space? We saw some slides yesterday during the preliminary discussions thinking about sort of just the comparison of financing going into problematic endeavors compared to environmental protection. And then the graphic on the right-hand side, they're summarizing the sort of emission reduction pathway laid out by the Mark Carney task force and the possibility for using private finance to introduce emissions offsetting for removal or sequestration as organizations, as the global economy moves down an emission reduction pathway. I'm now going to frame just at a high level supply and demand in the voluntary carbon market. So here we can see the quarterly issuances over the past few years across the entire global market, quarterly retirements and the subsequent surplus. I think the main thing to note here is that there's a high surplus of existing credits unretired, but this is to some extent legacy. There's a lot of legacy credits in the market that have been unretired. If we get a little bit more nuanced and think about the sort of the makeup of this surplus and the different credit types, while there is a surplus on the right-hand side of this chart, if you look to the very, very small black section labeled carbon engineering, that is actually being drawn down in a surplus. And I think this speaks to more broadly the sort of more intricate dynamics going on here, which is that when you look to the more highly demanded or the sort of more high integrity carbon credits available in the market, we are moving pretty rapidly towards a supply deficit, not a supply surplus. To think also about the demand side, this graphic here shows the increase in SBTI targets being set quarter on quarter, now reaching just under 5,500 targets set. These target setters have clear obligations to reduce supply chain emissions and engage with carbon offset purchasing, particularly removal credit types, which we think signals quite strong long-term demand for carbon credits or carbon offsets. Here now thinking about how the supply and demand begin to interact with each other over time. So on the left-hand side here, this is considering all credit issuances and a number of different demand profiles. This is research from Trove Research. So when thinking about the whole market, we start to see a supply deficit coming online, i.e. the elimination of that existing surplus by the 2030s, sort of late 2030s, depending on what demand scenario you consider. But if we start to flex assumptions a little bit, so for example, let's restrict the supply side to removal credits only, as is the restriction under SBTI obligations. That supply deficit is pulled forward substantially, sort of closer to 2027, 2028. And there are a number of other scenarios that we can play around with. So let's think now about the perceived integrity or quality of carbon credits. So here we've applied a fairly generic sort of quality minimum bar, so considering only CORSIA eligible credits as a minimum proxy bar, so that's the airline compliance scheme. When you consider only CORSIA eligible credits for supply, that brings the supply deficit timeline forward substantially again, so closer to 2025. Main takeaway here being that when you start to look at the devil in the detail and think about the conversations we've been having around integrity, the likelihood of increased target setting and demand in the space, we see a need for high integrity carbon offsets and carbon credits to come online pretty soon to meet the growing demand and the shortfall of supply. So what is a high integrity carbon credit? We've spoken a lot about it already, both yesterday and today. On the left-hand side is a distribution of integrity scores assessed by Trove. We've looked at a high level across the whole market, and no surprise really, there are some great projects and some not so great projects and some projects in the middle. I think the takeaway being, though, that this idea that 95% of all credits are junk is, I don't think, agreed with by a large portion of market participants. So what is being done to raise integrity? Again, we've heard a lot about different initiatives, but to summarize, SBTI, the Science-Based Targets Initiative, are really defining best practice and how to set an emission reduction target. Then the VCMI, the Voluntary Carbon Market Integrity Initiative, moves more towards defining how those claims can be made and if and when a carbon credit can be used. And then finally, the Integrity Council for Voluntary Carbon Markets looks to define the type of high integrity credits that firms can use, and they've issued the CCPs, the core carbon principles, as guidance for the type of credit that is considered high quality or high integrity. At the moment, if you look at the major purchasers of offsets, only about 10% of them would meet the minimum sort of quality bar that the VCMI are setting. Now that's unsurprising given that they've been procuring credits for a long time and the VCMI has just released its guidance. But I think what's encouraging is when you do consider those pool of offset buyers, they are decarbonizing faster than those not engaging with carbon credits. So this is some research recently done by my organization trying to look at these claims that companies are trying to buy their way out of supply chain emission reductions. We don't see that play out in the data. We actually find that the heavier users of carbon credits are on average decarbonizing their supply chains faster than those not purchasing carbon credits. So they are not using carbon credits, statistically speaking, to avoid supply chain emission reductions. So I'll leave it there for my intro and really move towards a Q&A for the panel, but we'll start off with some introductions. I've got a fantastic panel and who are going to speak to sort of investment landscape and how they are also delivering high integrity carbon credits to the market. So I think I'll start immediately from my left. Dominic from MillPont, please introduce yourself and let us know a little bit about what you're doing.
Good morning, and great to be here. My name is Dominic Sutton-Vermuelen. I'm the Chief Product Officer at MillPont. We are a designing, developing, and operating market infrastructure for large-scale decarbonization in commodity supply chains, so food, fuel, fiber, and really helping bridge the gap between the work that is foundational in VCM and voluntary carbon markets to supply chain, or what we call carbon insetting. Maybe for many in the room, but for many globally, carbon insetting is a relatively new term. I like to kind of think of it as the largest market in carbon that you've never heard of. It's anywhere just between 31 companies that have global commitments, about a $6 billion market today, going towards $6 billion over the next 3 or 4 years. We have one entity alone is already investing about $1 billion a year in decarbonization in their supply chain. And when you think of the supply-demand dynamics that Sam was speaking to, a lot of the decarbonization, specifically in agri-food, is going to be driven by nature-based solutions, regenerative agriculture, if you will. And there's only a limited amount of acres that can go into insetting or offsetting. And that demand paradigm is really going to drive some supply-demand dynamics that should offer more competitive pricing for these ecosystem benefits being derived off of these lands and higher value for the stewards. And that's where MillPont is really focused on, as our mission is helping enable those actions to occur and for these companies to follow up on their commitments. And we're seeing really some dedication to these commitments, and that's really encouraging and why we're, it's what keeps us going every day. From my background, just a little bit, I come to environmental markets from the markets side of the equation. Environmental is something I've been in and passionate in learning about for the past about 7 years. My background started as a commodity economist, but most recently I was helping structure and operate some of the largest carbon insetting deals in North America, working with the Soil and Water Outcome Fund, an entity that George mentioned yesterday. We were simply creating carbon benefits in agricultural supply chains and selling those to downstream market beneficiaries like Cargill, Hershey's, Nutrien, PepsiCo, and also pairing it with water quality improvements that were being sold to public beneficiaries, bringing higher value back to the farmers through that stacking of different types of ecosystem service credits, as well as multiple parties in the insetting transaction. So by insetting, we enabled multiple companies to share the benefits in their value chain, and that enabled a higher price point per metric ton of carbon. So instead of each company paying, one-to-one in kind of voluntary carbon world, where it's $15 or $7 a credit, maybe PepsiCo and their supply chain partner, Ingredion, would pay $15 each, allowing for a $30 per metric ton credit that would go to the producer. That's just an example. Prior to that, my experience was designing derivative instruments in agriculture, renewable energy, carbon, and water at the commodity CME Group, the world's largest derivatives exchange. And really, that kind of bridge between boots on the ground and seeing where markets are going was the impetus to say, we needed to design some infrastructure here that really brings around a market-based kind of programmatic and systematic solution to scaling that really we believe and helps enable a lot of the action and brings connectivity between offsetting and insetting world.
Thanks so much, Dominic. Tim, as CEO of Tradewater, you focus on sort of the development of GHG, greenhouse gas emission reduction projects, which are somewhat distinct from nature-based solutions or carbon removal projects that get a lot of attention in the press, but nonetheless, from a scientific perspective, the avoidance of the release of GHG gases is an imperative. So please, could you tell us a little bit more about what you do and why that's important?
Sure. Thank you, and good morning, everybody. It's a real pleasure to be here with you all, and really impressed with the range of folks that are here and your commitment, particularly on nature-based solutions and sort of enhancing the range of benefits that come from that work. I think it's really great. And I feel a little different because my work is not about that. It is about non-CO2 gases. I'm the co-founder and CEO of Tradewater. We're a project development company. We're headquartered in Chicago, and we develop projects in the United States and increasingly around the world. And we're a certified B Corporation, and our mission is to collect, control, and destroy non-CO2 gases. And we're seeking to do as much of it as we can, as fast as we can. I got into this work, my whole career has been in the environmental space with a big emphasis on pollution prevention. And I got into this work about the time that the California Cap and Trade program got going. I had formed a little development firm working on some methane work and some renewable energy, but really tuned into the California market. When it was kind of revealed that there were offset project types that would be eligible to meet the compliance obligation to some extent. And one of them was ozone-depleting substances, the collection and destruction of old refrigerants. And that really intrigued me. I had some background in that work. And when I left California in 2012, after I had been out there to learn about it, I came back to Chicago and I was playing around with my computer and I found R12 refrigerant for sale on eBay. That was an eligible ODS, ozone-depleting substance, so I bought it. And I thought, well, this is sort of interesting. You can actually prevent pollution by buying it. So I ended up just buying more and more of it because I just sort of felt like a very elegant solution to a very challenging problem. And when that market officially launched in 2013, I was able to get a purchase agreement for the carbon offset credits associated with destroying it, so long as I met a performance objective, which was 50,000 tons by a date certain. So we did that, and 6.2 million tons later, we are still doing this work, have served the California market extensively, but increasingly are participating in the voluntary market because we're finding gases all over the world. As you all probably know, non-CO2 gases are incredibly potent. We're talking in the refrigerant space at about over 10,000 times that of CO2. In the methane space, it's 84 times over a 20-year period. And so these are really important gases to get out. They are accelerators of climate change, and there is no pathway to 1.5 degrees without addressing these non-CO2 gases. So we feel really pleased to be in this space. We believe that it's complementary and strategic relative to nature-based solutions. You can't have just one or the other. You've got to have both. And so we offer these project types and the credits associated with them in the spirit of really going after the prevention of runaway climate change. One interesting thing about these gases that people don't necessarily appreciate is that they cannot be drawn down from the atmosphere once they're released. So nature-based solutions are not going to work for the large volume of non-CO2 gases that have been released and continue to be released in the atmosphere. And the only way to mitigate this is to prevent their release in the first place. So I encourage you all to go on eBay and buy more gases and put them in your basement, and then give me a call and we'll go ahead and get them destroyed for you. We're on a path to do about 22 million tons over the next few years. All of this is dependent upon a demand for the climate benefits that we are creating. So we participate in the carbon markets because it is a way to leverage climate finance to go after these gases at scale. But in order to really go after it at scale, we just have to know that the demand is there. And I think that presents remarkable opportunities and challenges when we think about the voluntary market in particular, with all of its peculiarities and challenges. Nevertheless, the climate benefits that we are creating are permanent, additional, they're measurable. They have they hit a lot of the quality buttons, and we believe that they are strategic, as I mentioned earlier, along with nature-based solutions and other mitigation measures. So I think that the opportunities are strong. I'm sort of excited to communicate with all of you and brainstorming around effective ways to really shore up that demand signal so that investment can flow into these project types, which are not widely known. They have traditionally not been particularly charismatic, but we're trying to make them so and really sort of demonstrate the strategic importance of these project types.
Great. Thank you, Tim. I think thinking about the flow of capital is a fantastic way to introduce Clark with environmental commodity partners. So Clark, please speak to your work.
Thanks, Sam. And thanks, everyone. This is a very exciting event for me personally, given the people in this room. I have deep experience in both wetland and stream mitigation, where I started my career, and obviously now more in carbon or environmental broadly. And there's a lot of people in both camps that are here today. Environmental Commodity Partners is an investment firm that deploys capital, as you can guess, across environmental commodity markets of all kinds. We trade allowances under cap-and-trade programs and emission trading schemes around the world. And we also invest in specific projects that will deliver offsets into compliance programs or in voluntary carbon projects as well, and that's much of the work that I do. I have, as I mentioned, experience at Resource Environmental Solutions, helping to develop wetland and stream mitigation projects, and in more nascent water quality markets. I worked in business development there, and on the commercial side, helping to identify the markets or watersheds that were most investable for the company at the time and define our strategy for expansion. So I hope to talk today a little bit about the parallels that I see between what is a more mature market in the Clean Water Act or the 404 markets here in the States, and what is a more nascent market of voluntary carbon, at least in my view, and maybe some learnings that can be drawn from one and applied to the other, as well as how we as investors think as we deploy capital into voluntary carbon projects, and what are the risks or expected rewards, and how we might underwrite those different types of opportunities.
Great. Thanks so much, all of you. And I think actually some of your last comments there, Clark, is where I'd like to start, thinking about what we can learn from other environmental markets that are perhaps less nascent. I'd encourage all of you to speak to what lessons we can learn from existing environmental markets, what positive precedents have been set, and how we can leverage that experience in attracting what needs to be serious amounts of capital to the carbon space. Anyone feel free to jump in there.
Yeah, I can certainly start, Sam. One of the key learnings for me in my career is that I at least have not come across an environmental market that at the start is, shall we say, efficient or operating the way that everybody hopes that it will. Voluntary carbon, I think, certainly falls into that bucket. Obviously, there are a lot of conversations today about how we build standards around these projects, how we define quality, how we define additionality. That is an impediment to investment. If you look at the 404 markets, the same is, or at least was true, I think, when that market started in the early 90s. You could look at it from then and compare it to today, and it is a very different beast. The projects are held to a higher standard today. But that doesn't mean that what happened before was bad or wrong. We have to start somewhere. And the 404 market, for me, at least, is an excellent example of that, of learning by doing. Something that I hope doesn't happen is that the market in the voluntary carbon space freezes up as we try and find what is the right way to do, but we don't continue to progress and don't continue to learn throughout that process. Mistakes will be made. There will be projects that get called into question, certainly. But for all of our sakes, I hope that those projects do continue, that the standards that come out continue to evolve, and we work to something that is progressive and better than where we see it right now.
Tim, how do you, speaking about sort of growing the market, attracting capital, barriers to project development, barriers to speed, what do you see as a sort of major challenges for you in your development of your projects?
Sure. I think the demand signal is what is important. If we know that there is a off-taker that is interested in this work, we can make the investment to go and do the projects. That's the key. And I think that in the compliance market, that's super easy. That is a massively efficient market, and we can sell credits into that market with whatever we can produce within a day. It works really well. Voluntary market, of course, is really very different. It's bespoke. The narrative is so key and important. I think that structures like SBTI make the work that make things very, very challenging. So companies that are making commitments and are working on their net zero, but will need offsets or will need to mitigate that which they cannot reduce, don't have an incentive to really do that in a way that gets counted by SBTI until the very end. And even at the end, it's about removals. And of course, the gases that we're dealing with, which are fluorinated gases and methane from orphaned oil and gas wells that are leaking, don't count. So the challenge just becomes increasingly difficult in order to get into that market, because it just takes so much time. You've got to find the right kind of buyers who are interested in scale, who really appreciate the work. They have to learn about non-CO2 gases and their strategic importance in bending the emissions curve. These gases are referred to as an emergency brake, pulling the emergency brake by project drawdown. But all that takes a lot of words, just like the ones I just used. So how do you deliver these opportunities and find that market ends up being very challenging. So if you're in my shoes, Not only are you building a global network to collect, control, and destroy gases, but you're also building a market. And those are two very hard things to do simultaneously. So those are the challenges. The good news is that there's, I think, a greater appreciation for this kind of work. And I think there are alternative structures that may or may not constitute a voluntary carbon market, but that may be opportunities to value climate benefits and to embed those benefits within products and services. And so those sorts of ideas and strategies are emerging that is possibly a pathway to scale as the voluntary carbon market continues to kind of work through its challenges and become a more efficient platform.
And I'm just going to combine my co-panelists' comments into layer on my own thinking is how do we learn lessons from existing, let's say, environmental and commodity markets, and then how do we create demand signals, sustainable and durable demand signals for these benefits in a systematic way. And I think, starting with lessons learned, in some ways that we can even create opportunities is looking at commodity markets today. Globally, they trade at around 5 trillion in notional value, and within that sector, there's existing infrastructure, empirical ways for driving value and discerning value, managing risk, and there's institutional capacity and folks that understand what the price of oil, the price of a bushel of corn is, and sends price signals that people make decisions from, whether to buy, sell, invest in. And what I'm saying is looking at demand, we have around 80 companies that actually touch 55% of that notional value today and are controlling it in a systematic fashion. They are sending demand signals for that value, for the value of those commodities. What if we start embedding the value of the externalities that those commodities produce into that system as a different quality attribute? So they're already looking at protein, moisture, velocity, other ways to discern value in their systems. You add carbon intensity, water intensity, biodiversity impact into this. I think it unlocks quite a bit of opportunity for accelerating the change we're looking at. Today, these global commodity systems already touch about 40% of terrestrial landscapes. If you can immediately tap into that, that's really I think you unlock a lot of nature-based solutions at scale.
I think, sort of to paraphrase or summarize a lot of what's been said, the demand signals are there, but they're unpredictable, potentially unstable, and their time frame is uncertain. For example, with SBTI, if you consider SBTI targets to be sticky and for those organizations to be engaging with the purchase of removal credits at their target year, will they do so? Will they meet their reduction pathway? How much will they offset? Will they be permitted to offset more if they don't achieve their complete reduction pathway? Will they forward purchase some credits to meet a future obligation? Are they engaging in forward contracts now to purchase those credits? So the demand is there, but the volume uncertainty, timing uncertainty. In light of that demand signal uncertainty, how should private capital think about balancing these risks of opportunity, of where to invest, what project types to invest in, what geographies to invest in, and what ultimately will be demanded by buyers?
Yeah, I mean, you nailed a lot of different risks there, Sam, and we have to think about
drill down
right?
as you see fit. But
it's not just demand. When I think about investment into a voluntary carbon project, obviously, I don't want to invest in a project where the demand doesn't exist, and that's a difficult thing to underwrite sometimes. But let's say that there's an offtake in place and someone has committed to purchase those credits. That's not a done deal, right? These are long-term offtake agreements, and is that a counterparty that I can trust to be there 10 years, 5 years down the line to make those purchases? And has the market shifted between now and then? That's also something to consider. And then there's the project itself. As we invest in new project types, particularly in the nature-based solution space, I think as many people in this room would attest to, a small pilot scale type science project, shall we say, to make a proof of concept does not always translate immediately to larger scale projects on the landscape. And if I have a new project type and I'm the first one in the door, I need to make a bet that when that is monitored and verified, we're hitting the actual number of emission reductions that I'm anticipating as I'm submitting my PDD. So there's that project risk that we have to underwrite. And then there's the geography that you mentioned, especially when you think about getting outside of the United States and North America. The government has a big role to play in some of these markets, and we've seen that start to pop up in countries in Africa specifically that are applying taxes or limitations to investment into the carbon market to make sure that some of that stays in country, and that's had a direct impact on people that have funded nature-based projects and technology-based projects in those countries in the voluntary market. And so when you combine all of that together as an investor, we have to design kind of these opportunities in a way that we are comfortable with ultimately on a just risk-adjusted return basis. I know that we all want to generate emission reductions at scale. That is the goal. But as I was having conversations with people last night, there's not enough pure impact capital in the space to make these bets. And we have to find ways to better underwrite all of these risks so that more investors will come to play.
Thank you. Yeah, I wanted to sort of explore another aspect of risk, which is essentially political or policy uncertainty. And from a science-based perspective, it is probably better to not cut a tree down right now that's sequestering carbon versus plant one that's going to take 10 years to grow. That, to some extent, flies in the face of SBTi's recommendations that you only engage with removal-type credits. So we need removals. We need to remove carbon from the atmosphere. We also want to prevent it, but we have certain issues and some project types around the methodologies of avoidance credits and the additionality concerns. So maybe one for you, Tim, to start off with. How, as a project developer, are you navigating the sort of relatively unstable advice, if you will, that corporates are being given as to how to engage with environmental assets and how to reduce their emissions, whether it be supply chain emission reductions or the engagement with carbon credits reduction or removal type?
I feel like by the time we're talking to off-takers, they have an interest already. You know, that there is some interest. I think that the challenges end up being sort of fitting into their overall thesis or their geographies or what have you. So, for example, we have a conversation going on with a buyer that was interested in some of our work on refrigerants in Southeast Asia. And we have a huge project going on in Thailand. It's actually a spectacular project of destroying confiscated gas. The gases that we collect are banned from production but are still in use. Anyway, they were interested in volume, but not in Thailand. They would rather us be in country X. And so from our point of view, that's another hurdle, because when all is said and done, it doesn't matter where the gases are. They're fungible in the atmosphere. But the buyer had another reason for wanting to create synergy within another country that they were connected in. That's a challenge. That's sort of creates an uncertainty for us as to whether we can completely marry our activities. Another challenge that we've had on the corporate side, we are plugging orphaned gas and oil wells that are leaking methane. And these are spectacular projects because there is no responsible party. So and these things are emitting now. It's not like they're going to emit later, but they're emitting now. And then they actually could emit a whole lot more later because often these wells are under pressure. But the buyer had concerns about the way in which the protocol works, which is the new ACR protocol, it has a 20-year crediting period that you take up in the first year. And so they were concerned about that, as if to say, that you're not, we were sort of pushing back to them to say, well, you're not plugging a little bit of the well this year, and then a little bit next year, and then a little bit thereafter. You're doing it all at once, and therefore that's why the credits flow that way. So these are examples of just the kinds of challenges that you face in dealing with interested parties, but have all sorts of other concerns that they're bringing to the table. And I guess it sort of gets to the confidence in the registry process and the offset protocol process that and with all of the media, et cetera, companies are concerned about what the implications are for different kinds of projects. But it just makes it very difficult because whereas these projects have strong additionality and permanence associated with them, it all has to fit within the narrative of the buyer. And each buyer is going to be different. They're going to come from a different sector. They've got different pressures. They've got different supply chains, different interests, et cetera. And so in building this market, you've got to figure out a way to align it all so that there's a connect and people feel good about the investment in the project type.
Great, thanks. Yeah, staying on this theme of the demand side, you mentioned stories, and I think carbon credit pricing comes into this here. What are the preferences of a buyer, but what is their willingness to pay? And to what extent is that willingness to pay defined by measurable attributes of a carbon asset or a story around them? And we heard Charles yesterday from Carbon Growth Partners talking about essentially how credits are being priced on a story basis. What story can an organization's marketing department potentially tell about a credit? How do you panelists see pricing of carbon assets currently, and how do you see the effective pricing of carbon assets going forward, particularly in light of the fact that currently most of the credits being retired are on the cheaper end of the spectrum?
I think Charles' comments were 100% on yesterday, but I don't think we can disclude the importance of the narrative and charisma of these environmental assets going forward. I think that becomes another attribute, a more qualitative attribute to other empirical attributes that today are already, Trove is doing some work, B0, Silvera, the Carbon Quality Credit Initiative, WWF, and I forget the other institute. But folks are drilling in on, and I'm seeing commonality being derived across some areas around permanence, additionality, durability, amongst a few other kind of rising to the top and subcategories under those. But I think that's kind of where the shift of some of those kind of quality attributes are moving towards. And it seems to actually there's a lot more consensus than that than I would imagine at this stage, given the 171 listed standards. I think that number yesterday also stood out as, I think it's probably very conservative because there's a whole host of unlisted methodologies out there, probably much double if not triple the amount.
Tim, you mentioned some of the very potentially specific requirements of your buyers. How do you see that translating into willingness to pay and then ultimately the way that you price the credits that you sell?
Yeah. We try to price our credits consistently, and we price them because we're building programs. So there's a kind of a feature with this work of new climate benefit that the way in which we organize the company is that as we sell carbon offset credits, that money goes into collecting, controlling, destroying more gases. So there's always an ongoing impact from any instance of a sale. And the cost of the programs are, they're high. We in the case of refrigerants, we we find it, we have to collect it, we have to aggregate it, and we have to ship it all over the world in order to get it destroyed. So there's a premium associated. Well, I shouldn't even say premium. It's just what the cost is what the cost is. In the case of orphaned oil and gas wells, we have to go find them, we have to measure them, we have to plug them, and and build an inventory and a pipeline so that we can talk to our buyers about, hey, you're going to buy credits from this particular project, but what you're really doing as well is supporting the development of an impact machine that we hope will get after these gases at scale as fast as possible. And so our pricing strategy is to price it so that we can do that. We're told by some that it's high, and we're told by some that it's the biggest bargain on the planet. So it's always in the eye of the beholder, for sure. So anyway, yeah, it'll be interesting to see, as these markets mature and as more participants are in the kinds of project types that we are, what happens. But we go for consistency so that we're sort of clear in our communication and we're across the board on the voluntary market. Of course, on the compliance side, that's different. It's what the market will bear, and that's a whole other situation.
Some think it's a bargain, some think it's expensive. I think, to summarize, really a lack of transparency in price discovery, which is maybe a bit of a problem in the voluntary market. Clark, thinking about opacity in markets and risks around investment and considering the ultimate sort of value of an asset that you're investing in, perhaps you could speak to this question of price discovery and investment risk, from your perspective.
Right. Yeah, I mean, I absolutely agree that carbon credits in the voluntary market today are being sold on this story that can be told around them. I think what's important, at least from my perspective, is that the story, or what is a great story today, doesn't mean that it is going to be a great story in 7 or 8 years. And when we invest in projects and we invest in this market, we're talking about that time scale, if not longer, very, very often. And so I have to be able to try and predict not necessarily what the story is today, but what is going to be accepted then. And that's proven to be very difficult, as we've seen shifting tides in what is accepted as high quality or not high quality, or what is preferred or not preferred, just in the last 18 to 24 months. Dominic mentioned the ratings agencies, and I know Trove is a part of that, and that is excellent work that's being done, and I absolutely agree that we're coming to a greater consensus now over what is additional and permanent and durable versus, again, just 24 months ago. But I also believe, and I've had conversations with people at those agencies, that they aren't perfect. They are changing their ratings on projects all the time based on the same information. ECP specifically, invested, it's on our website, into a cook stove project in Africa. We deployed 170,000 improved charcoal cook stove devices in Kenya, and we feel very strongly about the impact that it's having, not only on a verified emission reduction standpoint, but the benefits that also apply to that project. Well, articles come out that speak to some cook stove projects that maybe aren't delivering up on promises, and the entire market for that type of credits falls 40%. That's a very difficult thing to underwrite as an investor. What was a good story is now not. So we need to be, I have to be concerned about what is the next Guardian article, what is the next project type that will be viewed in a negative light, but also what is the new project type that will be viewed very favorably on that extended timescale.
Yeah, I think a big question that I have on the back of this is, and again, this has been discussed already this week, to what extent can you price the attributes of a story? Right now, we see ultimately carbon credits being priced in accordance with their capacity to extract a certain tonnage of carbon out of the atmosphere, and then they then have a premium or a discount based on what you might call additional attributes. Does it have a CCB status? Is it supporting the improvement of water quality? And there seem to be two schools of thought emerging here, which is really that you continue to price in accordance with carbon as the core asset, and you price above and below based on these additional co-benefits or attributes, or you begin to pass out these other benefits, be they social or environmental, and you price them in, and potentially you're able to stack those as having value and sell them maybe to separate buyers. So yeah, open question to the whole panel. To what extent do you think that we will start to see the passing out of specific attributes of an environmental project, be it carbon, social, water, or otherwise, and having them be priced differently, stacked, and sold separately? Or will we see coalescence around a sort of specific asset class, like a carbon benchmark that you deviate from?
I'll just use an example from commodity trading world. Kellogg's will buy a bushel of wheat for maybe its protein spec, and a Cargill will buy that wheat for its moisture or falling rate. Different attributes, different value for different buyers, same bushel of wheat, but being able to express and understand those allows that price discovery to occur. And that, I think, is where these markets for ecosystem assets or environmental assets, what have you, are moving towards.
Mm.
I think it depends on what the motivation of the buyer is, what brings them to the market. I think if it's climate, if they're seeking to address their climate commitments, then I think that they should be looking at the extent to which the projects they're investing are going to achieve that outcome, and that are going to contribute to preventing runaway climate change in time. If you are coming at this from a biodiversity lens or a water quality lens or what have you, and these projects provide those benefits and carbon comes along on the side, perhaps it's really the ecosystem service that ends up being the driver. So I think it would be nice to sort of think of it as a package, but I kind of think that where we're at now, it kind of depends on what the objective of the off-taker is.
I think my one piece of input here would be that the markets are already complex enough, if not too complex. While I know that people will continue to try and value these different attributes differently, and there is probably value in doing so, where buyers are willing, to pay more in sum for each individual attribute than as a group. I mean, someone's going to split that up and try and take advantage of that. And I think it can be done in a reasonable way. At the same time, I think for this market to grow and for these markets to grow to the scale that we all hope they do, simplification would be better, at least in this time.
All right, I'm going to open up to Q&A very shortly, but just before I do, I want to zoom out very slightly and sort of think really about what this conversation is, which is getting heavy emitters, heavy polluters, the buy side, to allocate capital to environmental protection. And there are a few vehicles to do that. We're talking predominantly about voluntary carbon markets and carbon offsetting here, but there is also insetting that's possible. SBTi have come out and said clearly that they will permit insetting within supply chain as counting towards supply chain emission abatement, as being distinct from offsetting a residual at target year. And Dominic, I know we were speaking earlier today and yesterday around the evolution of the insetting market and how insetting is another vehicle for heavy emitters to allocate significant amounts of capital to reduce their Scope 3 emissions within supply chain. I wonder if you could speak briefly to how you see the insetting market evolving, what you see the major risks are in insetting, and maybe also, as a third, how it's interacting or will interact with the offset market.
Start with risks, and I think some of the risks are the same as the traditional voluntary carbon market today, in that permanence is at the forefront, as is durability of these benefits. But I think one of the things that is different is how to address those. And there's already, it's through they're using already traditional paths for commodity origination, selling, and trading. So there's a sustainable demand signal that comes with insetting. So, these companies have these global supply chains that feed into their manufacturing processing, that they then create value-add products that we eventually buy off store shelves or go into feeding animals that we then buy, or into fuel that we then put in our cars or take airplanes. And all that is to say is there's a continual signal already being sent through a trusted channel for insetting. And that turns carbon as a quality attribute into a commoditized product in something that is, driven year over year. The same reason farmers are planting corn or soybeans or growing cattle. It's their livelihood. And they're doing that not because they hope that they might be able to sell that commodity next year. There's a market signal that is allowing them to take that risk. Farming is a very risky business. You're playing every year, rolling the dice with the Mother Nature, hoping that you can generate enough yield to sustain your livelihood and feed your family. So having extra cash markets on top of that, like a carbon offset with added complexity, is a little much for these kind of complex production systems. So when you're embedding it into their current practices with an additional premium for the carbon intensity of that product, it's a clear and easier pathway for adoption at scale. And then what do I see as kind of that, what was your last one? Yeah. Interactions
with offset markets.
It's all on land-based assets today. I mentioned before there's about 40% of terrestrial land is in agriculture today. And I'm focused on agriculture, but it's just because global food systems produce about a quarter to a third of global emissions. So it's just where, and it aligns with my background. But carbon insetting can go into, there's about 8 supply chains actually that make up about 50% of carbon emissions today, and that's auto, CPG, or fast consumer product goods, electronics, professional services, freight, but ag's the biggest one. But today, so I'll go back to how does that interact with voluntary carbon markets, and that they're looking at the same acres to implement and scale solutions on, and there's about 5 billion hectares of land available, and that can go into insetting or it can go into offsetting on a given year, but not both. And that is, they can overlap at different, one crop rotation can go into offsetting, one can go into insetting for that given piece of land, but every year they have to have a different vintage, if you will. And then how they interact, I think we need everything, everywhere, all at once. So it's, at the end of the day, I don't think there's going to be a either or option. It's an and both of those are driving important climate finance to the land.
Great. Thank you so much for such an eloquent answer. All right, got about 15 minutes left, so yeah, opening up to Q&A. I definitely saw a first hand over here. Yeah, go ahead, and then next, please.
Thanks. Thank you, Sam, and thank you to the panel. My name's Jody Bickle, CEO and founder of Creek Bank Associates, and we provide technical and coaching advisory solutions for private and public clients. And so where you landed there at the end, I really appreciate that. And so my question really is to ask you all to provide a little bit further perspective from the large landholder seat here at the table. So relative to how they would engage in this marketplace. So just some additional insights about the insetting, the offsetting, their role as a large landholder. Could it be a project developer, third party, a lessor, for example, the project structure, and the value proposition around that. So I'm just keeping informed where we ask about 6 questions at the same time, so I appreciate your response to this.
Who wants to go?
Working with large landowners, I think the most important step in that journey is starting to understand your position from a scientific measurement standpoint. So doing the best you can with the resources you have to at least understand your baseline, and that will give you an informed position to interact with these other opportunities. Because a lot of what these interaction to date will be is inbounds that tell you what you can expect from a landowner's perspective, is tell you what you can expect to produce in the price range. And if you're not actually actively going after and producing that information yourself, then you're beholden to others that will be producing that information for you, hopefully to your benefit, but not always.
I think my perspective would be, first, I never want to be the person to tell a large landowner what to do with their land. That's never going to end well in my experience. Second, it's obvious that the opportunity set available to large landowners for both what they can do, small steps that they can take, be it agriculture or timber holdings, that are both proven to be beneficial to their bottom line as they look to monetize their land assets, as well as for the environment, are there. And I would hope that they are pursuing those independently or with the myriad of firms that can help them do so with sustainable grazing and sustainable agricultural practices. And that we could probably do a better job as a group on the education factor where that needs to be improved with some of these landowners on the opportunities that do exist. Just thinking about agriculture more directly and the way that carbon has played into that is still very new, and there have been a lot of landowners that are hesitant to move into that market, and we need to find ways to expedite that process. I think soil, sequestration of carbon is a very available and not low-hanging fruit per se, but easy to access opportunity to contribute to the overall solution set here. And just as one example, I think that's been slow on the uptake, unfortunately.
Question in the back there.
Craig Ebert, Climate Action Reserve. A lot of our discussion this morning has been around the traditional carbon credit market. But Sam, you laid out the global landscape affecting action on climate change, starting with SBTI, ICVCM, and VCMI, and others. The sad reality is all those efforts are collectively trying to restrict what the traditional carbon credit market is doing, which has been under development for decades. We all know it has issues. But I think we're fundamentally flawed globally in the direction we're setting. Science-based target initiatives sounds wonderful, but that direction to focus on one supply chain is, I believe, fundamentally misguided. Let me just explain why. The focus there is on supply chain or value chain mitigation, or what some people are calling insetting. Let's not kid ourselves. Insetting is nothing more than a special form of offsetting that is found within a given company's supply chain. For everyone else, it's an offset opportunity. That's an important distinction when you're telling folks to focus on their supply chain. It's limiting their flexibility, not increasing it. Moreover, then you got groups like ICVCM that come in and say, we have these core carbon principles we're going to apply to the traditional carbon credit market, but guess what? They're not doing that for the value chain actions. We're in the midst right now where they're trying to, here in 2023, they're reinventing the wheel to define a new set of guidance for what supply chain mitigation means at a time when we can ill afford it. Just interested in your response to that, because it really is going to restrict ultimately what collectively many of us are doing.
I think it's a really good point there, and it speaks to the fact that ultimately markets are about allocating capital to the lowest marginal cost of abatement globally. And when you start to think about tranching off demand and supply into different supply chains, you start to move away from global allocation of capital to lowest marginal cost abatement. But yeah, that's just really a comment from me. But yeah, open it up to the panel. Maybe Tim, particularly as a project developer, how you see some of these integrity initiatives affecting your business operations or affecting the profile of demand for your credits?
Well, I think that they have a big effect. I'm not going to, I think Dominic is probably better suited to speak to your question or your comments about the insetting and supply chain stuff. From where I sit, our ability to do this work to achieve these climate benefits sort of puts us in this market for better or for worse. This is how it's going to get financed. So I think that we've had some challenges in dialogue with buyers because of SBTI and because of the way in which it's constructed, and the use of offsets, the focus on the end, the only acknowledgement around removals. And there's another sort of peculiarity here that I should mention, which is that in the case of ozone-depleting substances, which are the refrigerant gases that I've been mentioning that we collect and destroy, these are banned from production by the Montreal Protocol, but they are still very much in use and they're very potent. They do not show up on in the greenhouse gas protocol as gases that need to be inventoried and reported in terms of emissions. These would include CFCs, the chlorofluorocarbons, and the hydrochlorofluorocarbons, so that a company that has these gases that could be collecting and destroying them as part of their net zero commitment will not get credit for doing so under SBTI because they're not reportable under the greenhouse gas protocol. So that's annoying, and it's a real limitation of the program relative to the project types that I'm involved in, which are the non-CO2 gases. So, as the market chugs along and organizations like SBTI, which deserve enormous credit for organizing and encouraging companies to make net zero commitments, but the more that kind of platform emerges as the standard bearer, the more that you can start to look at what it's not addressing and what the opportunities that are being missed, that are gases that are being left on the table that really need to be addressed now, not in 2040, but now. So anyway, enough of the soapbox. Pass it to you, Dominic.
No, it's a great question, and it's why I left my comments with everything, everywhere, all at once, because I truly believe that the way we should look at the ecosystem service benefits, carbon, water quality, what have you, being generated by land-based assets specifically in agriculture, is they need competing markets to exist for those with different demand signals, if that's offset or insetting. And that is actually, I think insetting is additive and complementary to voluntary carbon markets today, and in a way that drives multiple pathways for monetization and competitive pricing. We need price discovery, and that doesn't exist if you have one more or less, while complex, monolithic structure for pricing these assets. And today, it's kind of I would say when you have a vacuum power or a vacuum of authority in any area like the voluntary carbon market does, then it's going to be filled with folks who are kind of creating standards and guidances, and until it's enforced in a regulatory capacity, companies have to adopt something to move forward with their action, and that's they're going to go to wherever the kind of concentric circles are being formed, and that seems to be SBTI as being one of them. For better, for worse, I think everyone in here has the right intention of creating, hopefully, efficiencies and ways to standardize these processes. But when you have a lot of cooks in the kitchen, there's going to be some broken eggs.
Great. Question back right over here. If we could keep questions and responses as brief as possible, we've got about 5 minutes left.
Yeah, thanks. I take it back. I think maybe this is the most important panel. So, kind of maybe contrary to the last question, the commodity markets and the real economy and the financial economy that supports the real economy are almost infinitely larger than the environmental markets and finance. So that's probably the most important area of interoperability. So can you define the critical steps needed for us to make the kinds of activities we're talking here internalizable or valuable in physical commodity trading or in the strategic decision maker for transition finance for a large global corporation? Because right now, I think that, maybe aligned with what he said, SBTI is actually getting in the way of that, the balkanized standards get in the way of that, and the inability to actually account for the things you're doing across the many domains you have to account for is not allowing a CEO to make that decision, much less make that case with his investor and his shareholders and all the different stakeholders that are coming down on him.
So how to internalize those externalities potentially without the impetus of policy currently? Go.
Well, I was going to say policy.
The answer can't be policy. Not allowed.
I don't know if I have a good answer to that. I think you've seen policies that are very effective at doing this, and those are markets that we are active in at ECP. California being one example, the EU being another, is kind of the two big ones, but there's lots of smaller ones, and there's new ones popping up every day. That's not the answer. You said I can't say policy, so I'm at a bit of a loss on how to respond beyond that.
I think capacity education is where it starts, and I've seen this in working with a whole host of teams across the commodity sector. 5-6 years ago, it was one, chief or sustainability officer. There's been a lot of hiring and a lot of capacity building in internal teams to manage these environmental commitments as balance sheet assets, not looking at it from a view of a marketing or a corporate social responsibility standpoint. They're actually now creating interoperable systems and processes that go from how do we operationalize and systematize our climate commitments and put them on our balance sheet. So some of the largest companies in the world are doing this actively, and the conversations and the level of expertise from who I was interacting with maybe 5-6 years ago, there's a lot more PhDs involved, I would say, a lot more engineers, and a lot more people with capital markets experience.
Tim, any final comments?
I would just quickly add that if the projects can be problem solving for a decision maker relative to addressing their reporting commitments, their mandates from their board, from their financial institutions and lenders, from their shareholders and employees, if you can kind of find that sweet spot, it would seem to me a pathway to green light. But these are huge challenges to align all of that. But I think we all need to be doing that, is figuring out how the projects that we are offering resonate with the buyers and without having to compromise the project or twist it too much.
So I just want to summarize the two thoughts, because I want to, one, make it compatible with internal accounting and the value accounting required by the financial systems, and two, figure out how to internalize it into internal decision processes of the company so that it is not a process you're trying to run outside your normal capital allocation planning or all those things. Does that summarize it quickly?
I would say, and I'll add to Tim's mention that struck a chord, is also bringing value add to it beyond it's not a cost center, it's a revenue generating opportunity that I can either create a value add product for downstream my customers and affiliated stakeholders and my shareholders, or I can at least get cost share and co-investment opportunities with my value chain stakeholders in the case of insetting. That is unlocking a lot of this action in my mind.
I would maybe just finally close as well with saying that I think it is also about unlocking perceived value for investors. The investor community has billions of dollars to move around at its fingertips, and as we start to see mandates on environmental action for investors' holdings, and those investors instituting certain restrictions or divesting from certain industries or away from certain organizations that are not instituting sufficiently fast action, that movement of investor dollars starts to speak to corporate action as it pertains to the purchase of carbon assets. Well, anyway, we're tiny bit over time, so thank you, everyone. Thank you so much for your questions, and thanks so much to my panel as well. I hope you enjoyed it.